In this presentation, we will create an invoice with an inventory item related to it. Time to push forward with Sage 50 Cloud Accounting. Here we are in our Get Great Guitars practice file. We're currently in the inventory and services item. I'm going to go back up to the customer and sales items here. Now we're going to be creating a sales invoice. Before we do so, it's useful to look at the financial statements and consider the effects. So whenever we go into basically any of these types of forms, this is what I would suggest doing until you get used to this and until it becomes automatic, is to think about the financial statements and think about the effect of the financial statements before you create the form, then create the form, and then go look at the financial statements and look at the effect of the financial statements after you have created, basically using the financials as kind of like an auditing tool, going from the end product back to the source document. So let's do that. We're going to go to the reports up top, and we're going to go to the financial statements. We're going to be opening up, of course, our favorite two financials, that being the balance sheet and the income statement. I'm going to be taking this for the range of January 1st to January 31st. There is our balance sheet. Let's do the same thing for the income statement, the P&L, the profit and loss. So we'll be picking up the income statement. I like to use this one down here, the income statement, and I'm going to say this one for January as well. So there's our income statement, and there's our balance sheet. So I'm going to make these large, got the correct dates on them. Now, when we create an invoice, it seems like the most basic kind of form. It is a pretty basic type of form, but note that setting up the form to have it easily populated, easy to do the data input, a little bit more difficult because we had to set up those items in order to do so. And the effect of the invoice on the financial statements is fairly complex, especially if we are selling inventory and have sales tax related to it. It's not like just two accounts are affected. We have a lot of accounts that are going to be involved here. So if we think about the invoice, what's going to happen when we create it? An invoice means that, and also just note that if you're used to financial accounting, you probably think about everything in journal entries. You want to do a journal entry, but most of the things that you're going to be working with in the normal system of accounting, when you think about the normal accounting process in the database system, is going to be driven by forms. So then you got to and the forms are almost purposely masking the journal entry to make the data input easy. So we have to basically think about those forms and then be able to visualize the journal entry that's going to be involved or the accounts that will be affected as we enter them. So the invoice, when you see it, when you hear invoice on journal entry standpoints, you visualize accounts receivable. Invoice means accounts receivable. So the accounts receivable will be going up. A customer will owe a customer. So a customer account will go up. They owe us money. The other side is going to be on the income statement. That would typically be the other side of the receivable. And so if we go on over to the income statement, then that's going to be revenue. So we're going to have some kind of revenue account that's going to be increasing. Now the accounts receivable is going to go up by the total amount that is going to be owed to us. That's going to include the sales amount plus the taxes, if there's sales tax involved, as there will be with the inventory items. The revenue, on the other hand, will only go up by the amount we get to keep, which is the amount that we charge not including the sales tax. The difference between the two, bouncing back over to the balance sheet, will be a liability account down here. It's going to be somewhere in the sales tax payable. We should see a liability for sales tax payable once we record this. Then what also happens if we sell inventory, this is not subject if we don't sell inventory, obviously, but if we sell inventory, then inventory's got to be going down by the invoice, an amount that won't actually be on the invoice, but we know what it is because it's driven by the inventory tracking under the FIFO method as we enter and track the inventory item in a perpetual inventory system. The other side related to the inventory is on the income statement, and that's going to be in an account called cost of goods sold. So all those accounts are going to be affected. The net effect on the income statement is going to be revenue increases by the sales price minus the expense of us giving up the goods, cost of goods sold, difference between the two, net effect, net income. All right, so let's go back on over and do it, and then check that out and see if our analysis was correct. So now we're going to go into the sales invoice. We're going to say we want to make a new invoice here. Going to make this large as we can make it. We're going to hit the drop down. Our invoice is going to go to Jones Guitars. So we actually have Jones already set up. So that's going to be our customer. This customer is over their credit limit. I'm going to say okay. So they're on warning, Jones, because you're over your credit limit. And so we're going to say this is going to go to them, and I'm not going to put an address. This is populating from the customer section, which is good. So we set that up already. This is going to be 011220 invoice date, due date, given the terms that are our default terms, then February 11th. Invoice number, we may need an invoice number. I'll put a number here. And then we're going to keep this ship date. We're going to keep that as is. Keep that as is. Then we're going to go to apply to sales rather than apply to the sales order. So we're going to apply to the sales here. We're going to be picking up the quantity 1. It's going to be a Gibson USA that we are selling. So you could select it in the drop down, or you could just type in the Gibson USA, which is a GUSA. And then the description will be populated with the Gibson USA, the amount of the 380. The tax, it is going to be taxable, it populated for us, and the amount then at that 380. Then we'll apply the tax down below, so we got to make sure that we select the proper tax. I'm going to make sure I get the 9.5. There is our tax, so that looks good. Everything looks good. So what's going to happen? So now I'm going to analyze it again. I'm going to visualize this from now the statement of the invoice. What's this going to do when I record it? And this is what I would do with every data input form that you're going to make until it becomes automatic. Well, this is an invoice. That means that it's going to be increasing the accounts receivable by the total amount that's going to be due to us by the customer, the $416 and 10 cents. The other side is going to go to revenue, but that's not going to include the sales tax. It's only going to be for the $380,000 increase in the revenue. The difference of the sales tax of the $3610, that's going to be going to a payable account, sales tax payable or something like that on the balance sheet side of things. Also, the inventory should be decreasing by some amount that's not even on this invoice, because this invoice is going to the customer. We don't want them to know what we purchased it for typically, but we do want the invoice to drive the perpetual inventory system to record the inventory. How does the system know about it? Because we set up this Gibson USA item, and when we did so, we set up the cost, and it's going to be using that first in, first out method to track the cost, even though we can't see that cost actually on the invoice. The other side, it's going to be going to cost of goods sold, which is an expense account related to it. So that's what's going to happen, we think. You want to visualize that. Then let's go ahead and record that, and then check out if that is indeed what happens. So we're going to save this. You're about to save the transaction. I'm going to say yes. Let's save it. Let's close it. Let's go back to our financials and analyze this again, right? And I know this is a lot of analyzing, but we're going to go back over here. We're going to refresh this. And then we're going to say the accounts receivable. It should now be increasing. So if I go into the accounts receivable, there it is. If I double click on that, we see the 416. And notice this is kind of like the auditing type of method now. Now we're going to the end document and tracing back or going back to the source document, right? We're drilling back into the source document. There's the full amount that's due on the invoice, which is the 416. I'm going to close this back out. Close this back out. The other side is going to go to the profit and loss or income statement. If I go to that and make sure it is refreshed, there's that 380. So the 380 is the amount, not the full amount that's owed to us. That's the amount that we get to keep, right? That's the sales price up top. The difference is that 3610. That 3610, where does that go? Well, that's going to be back on the balance sheet again. So I'm going to close this out, and go back to the balance sheet. And we should have another account that's been created for sales tax or something. Sales tax payable. There's the 33610 that's going to be owed to the state. So also the inventory should be going down because we sold inventory and we're using a perpetual inventory system. System is tracking the inventory for us, meaning it's tracking it as we make sales. And therefore, if we go into this one, there's 304. I don't even remember seeing that number, but that is our invoice, isn't it? If I go into that invoice, there's our invoice. The 304 is not on here because we're giving this invoice to the customer, and so we don't want it on there. But we could check out where it is if I close this back out and we were to go back over to our data here and go to the inventory items for the inventory items and check out the inventory items. And if I was just to view them, and we're looking at the Gibson, I believe it was a Gibson USA. This one, there's the 304. See, the system knows what it is, even though it's not putting it on the invoice. The other side of that is going to the income statement. So the income statement, there's the 304 and the cost of goods sold as well. If you double click on that, then of course there's our invoice. What's the effect on the net income on the income statement? Well, it went up by the 380, and then cost of goods sold or expense went up by the 304. The difference, 76, is the effect on the income statement of that transaction. Also note that if we go back over to the balance sheet here, if we go back on over to the balance sheet, we have the accounts receivable that's been affected, right? The accounts receivable, and we need to break that out by who owes us the money. If we just drill down on it, it only gives us the information by date. So therefore, we can also track this information if we go back over to our reports, go into the accounts receivable and look at the aged receivables. If I was to say aged receivables, and we're considering we made a sale now to Jones Guitars for the 416, there's the sale of the 416 that they owe us. And then if I go all the way down to the bottom, we're at the $20,916. It's at the end of February, but that should be okay because we haven't entered any data after that. So $20,916. If we go back to the balance sheet, the balance sheet is over here. I got a lot of $20,916. That should always tie out, right? And then if we go into the inventory, we also had inventory affected. So we can say, all right, we should go into the inventory and check that out because we should have another report related to inventory. How about an inventory valuation report? If we go into that inventory valuation, we have the Gibson USA. Is that one of these we sold? We don't have any more of the Gibson SB and the Gibson or we just purchased the Gibson SB, and I think we sold this one. So in any case, this ties out now to the 2,592. 2,592. If we then go on over to our balance sheet, if I take a look at the balance sheet, then we've got the 2,592. So we have the supporting documentation for those items. In other words, we need kind of like a sub-ledger for the receivables and the inventory, which will be affected on if we're using a perpetual system as we enter invoices. So note the invoice is kind of like a basic type of form that we make all the time, and the data input is not difficult to do if everything is set up correctly, but it does actually have a lot of things involved with it, both with regard to the setup process, setting up those items to make that data input easy, and with regards to all the effects that are resulting from it on the financial statements. So that's going to be it for now. Let's get out of here.